Hey guys, welcome or welcome back. I think Croc stock is worth another look. So in this video, I'm gonna give you some data that I've put together and really make a case for why I'm bullish on this company as a mid to long term hold in my portfolio. Here, I've pulled 5-year average ROIC of some different footwear companies, gross margins, and price to earnings and price to free cash flow ratios. I pulled this data from fiscal.ai on Saturday, March 21st, 2026, and I asked Gemini to put this bar graph together for me. And here, this data really gives you an idea of how cheap I think this stock is right now. You have Deckers, Crocs, Nike, Under Armour, On, Birkenstock, Adidas, and Wolverine represented here. And if you look, this is ordered by 5-year average ROIC. So Deckers has 61% ROIC on average over the last 5 years. Crocs, though, is second at 32.2%. And this includes the HeyDude acquisition, which I would say has very likely weighed on that number. And we'll talk more about the direction I think that that acquisition will go into the future, and or at least how the remaining impact might might be seen. From there, you can see 5-year average ROIC is then ordered by Nike, Under Armour, On, Birkenstock, Adidas, and then Wolverine. If you look at the gross margins, Crocs is 58.3% gross margins, actually higher than Deckers, and the only company that's actually higher than Crocs is On at 62.8%. Birkenstock is tied at 58.3%. But then when this really gets really interesting is when you look at the multiples for these stocks. So we have the next 12 months price to earnings ratios and the next 12 months price to free cash flow ratios. And here you can see Crocs is trading at 5.6 times next 12 months earnings and 5.8 times next 12 months price to free cash flow. You compare that to Deckers at about 14 times both. You compare that to Nike at 25, 32 times both. You compare that to Under Armour at 25 and 43, or 20, about 26 times forward earnings and about 43 times forward price to free cash flow. You compare that to 24 times for On. You compare that to about 14, 15 times for Birkenstock, Adidas at 12, 17 times, and then Wolverine at about 11 and 12 times. So Crocs easily the cheapest of all of these companies. And when you look at the 5-year average ROIC and the gross margins, you can see that this is actually very compelling in terms of the valuation relative to the performance of the company. The free cash flow yield on this is back up over 17% now. You've got, yes, stagnant revenue over the past couple fiscal years. However, the share count continues to decline rapidly. So you're looking at about 50,200,000 shares left as of the end of the last fiscal year. They bought back over 11% of shares outstanding in the last fiscal year. So year over year. So you can see how the share count has declined significantly. And I don't believe the market is really giving the stock enough credit for how much capital they're really able to return to shareholders here, even with revenue not not being able to grow in recent fiscal years and the struggles they've seen there. Now, there's some reasons why I'm optimistic about them at least being able to continue this double-digit capital return to shareholders, or to see revenue grow in such a way where the stock could be re-rated at a higher multiple. Basically, some catalyst for share price appreciation over the mid to long term. And those reasons include the fact that the company has seen a lot of growth in China, You can see here how Crocs became the right fit for China's Gen Z, and also how Crocs is trying to grow the brand in India. This is a recent article here. Crocs makes a play for athlete lifestyle with KL Rahul global deal. He's a cricket player, and so I think what Crocs is doing is they're trying to grow the brand more internationally. They also do a lot of production in China and India, so this will allow them to avoid tariffs if they are selling more products in those countries. And these countries also have populations that are larger than North America. So I think Crocs as a business is seeing an opportunity here between the tariff headwinds for North America and the United States market, and then the uh, the ability to grow brand awareness and sales in these countries that have very large populations. I just think they're seeing an opportunity here, and they're trying to focus on those markets more. From the last earnings call, you can kind of see Andrew Rees, the CEO, uh, make note of the fact that the international business is about to be a bigger part of the business than the North American business. He said, yeah. And I think what I'd add to that, John, is look, it's a very clear priority for us to return the Crocs brand to growth in North America. As an element of context, I would also remind everybody that the Crocs brand in 2026 will actually be bigger internationally than it is in the US. And we're very confident in about a 10% growth rate for our international business. So that just shows you internationally, Crocs is really focused, I think, on becoming a more significant international brand, and they're seeing a lot of growth in those areas. If they can also return North America to growth along with that, then you're looking at more revenue upside. But even if they can just keep North America relatively stable and continue to grow the business internationally, I think they're going to continue to be able to maintain all those things with solid margins and free cash flows that they have at their advantage. Now, another thing that's weighed on the brand was the HeyDude acquisition. But as you can see here, HeyDude is just 18% of the revenues for the brand. And they took the write down on the brand in Q2 2025. And so that write down has happened. There's a chance now that maybe the worst is over in terms of the HeyDude acquisition. Maybe this is actually almost like a call option built into the stock now, where if HeyDudes really start to become popular again, you could see yet another reason to be bullish on the stock. But if they don't, if they can just stop the decline or minimize the decline, the worst of that acquisition may be behind them at this time. So that's kind of my view on it. Now, Crocs has also continued to have solid partnerships. They've got the Lego partnership going. They just did another partnership with McDonald's to be involved with the Happy Meal. They also have done the LoveShackFancy partnership, which I didn't know about this brand really before this, but I guess it's a brand that women like. So Crocs continues to be relevant in pop culture and to form these partnerships with companies that allow them to have a place not just for people who want to have Crocs that represent things that they like, but also for collectors. So I don't think that this is a brand that's going anywhere. And yet, as we saw at the beginning, the market really right now is pricing this like they're a dying company. And I mean, less than 6 times forward earnings and forward free cash flow is just insanely cheap. A 17% free cash flow yield. This is insanely cheap with the capital that they're returning to shareholders via buybacks. And the balance sheet, they paid back a lot of the debt from the HeyDude acquisition already. They still have some of that on there, but the balance sheet is fine. So, as a mid to long term hold in my portfolio, like I said, I really like the potential of Crocs here as a stock, and I am considering buying more of it. You can see here, the stock is getting close to another support level that goes back quite a ways. It's really just sold off again recently. You know, the overall market has struggled, and that I'm sure has weighed on it as well. I don't know where this sell-off will end. If you, not financial advice, but I would maybe wait for some momentum if you don't own any Croc stock yet and you're interested in the stock. Obviously, do more of your own research than just this video, but um, if you're interested in this stock, I would maybe wait for the sell-off to end and to see some positive momentum. But I just find the valuation on this company really compelling. They people continue to pay for the Crocs brand. I know there's all the fears out there about the knockoffs and things like that, but I think that it's a strong brand name that people will pay the 50 to $80 for, as opposed to just buying the cheap, you know, um, generic product. Because at the end of the day, 50 to $80 for a pair of shoes is really not expensive. And to be branded and something that's lasting and durable, I think people are going to continue to pay for it, especially with all the partnerships that Crocs is doing and the things that they're doing to continue to grow brand awareness. And you're also seeing them get more into other things like sandals and bags and stuff like that too. So they're going beyond shoes. Just a lot of things that I think will give the brand staying power. If you didn't see my video after the last earnings report, make sure you check that out. I give my valuation at that time for the stock, and I'll update that valuation after the next earnings report. So if you're interested in seeing what I said I thought the stock was worth after that earnings report, make sure you go check that out. And if you got something out of this video, please like, subscribe, click the bell to get notifications, and follow me on X at Stock Sale Flyer. I really do appreciate all the support. Thank you so much. Take care. Bye.